All right, today we're diving into a company that really has people talking, VVIP Infratech. Is it a rocket ship about to take off, or is it a ticking time bomb? We're talking about a pretty small infrastructure company with an order book that is, frankly, massive for its size. So, is it a hidden gem? Let's find out.
And that's really the big question, isn't it? On one hand, you see all the signs of explosive growth, the kind that could point to a real multi-bagger stock. But on the other hand, there are some pretty bright red lights flashing that could signal some serious trouble ahead. So which is it? Let's dig into the data and see what we find.
Okay, so first things first. Before we get into all the drama, the growth, the risks, we've got to understand what this company actually does. And right off the bat, the numbers tell a really interesting story. With a market cap of just 448 crore, it's definitely a small cap player. But look at that PE ratio, 12.4. I mean, that is scraping the very bottom of its sector's range. And that low valuation is the central mystery here, right? Is this company a massively undervalued gem, or is the market seeing risks that we haven't uncovered yet? So, what do they actually build? We're talking about the real nuts and bolts stuff. Critical infrastructure. Think sewer treatment plants, electrical grids, major water projects. They're what's called a Class A contractor, which is a big deal. It means they're qualified for these huge government jobs, like the National Jal Jeewan Mission. So yeah, this isn't some flashy tech startup. It's a business that builds the essential foundations of our cities.
Now, let's look at the case for growth. And honestly, this is where the story gets pretty compelling. The numbers we're about to see are just staggering for a company of this size.
Just take a look at this number, 673 crore rupees. That is the size of their current order book. To put that into perspective, that's 1.5 times their entire market capitalization. That is a massive, massive pipeline of secured revenue just waiting. And if you thought that was impressive, check this out. Through one of its subsidiaries, VVIP has a joint development agreement in Greater Noida. The potential revenue from just this one single project over the next 4 years, an estimated 900 crore rupees. That's double the company's current market value from one deal.
So you might be wondering, okay, big orders are great, but does it translate into actual profit? Well, absolutely. For the half year ending in March 2025, their net profit grew 2.6 times year over year. This isn't just some future promise. This explosive growth is already hitting the bottom line right now.
And then there's this, what many people consider the ultimate seal of approval, promoter buying. The insiders, the people who know the company better than anyone, are repeatedly buying up shares with their own money. It's just a really powerful signal that they believe in where the company is headed. Okay, all of that sounds absolutely incredible. So why isn't every investor on the planet piling in? Well, because as compelling as that growth story is, there's some pretty significant warning signs on the dashboard that we absolutely have to look at. First up, debt. And wow, this slide tells a stark story. In just 6 months, from March to September of 2024, the company's borrowings nearly tripled. They jumped from 44 crore all the way to 120 crore. Now look, growth needs fuel. I get that, but taking on this much debt this quickly, that is a high-risk strategy. Then there's this. In the very same month that their debt was spiking, an independent director on their board, Adarsh Rastogi, suddenly resigned. And crucially, there was no official reason given. He just left. And this is the question every investor has to ask themselves. Independent directors are supposed to be the watchdogs for shareholders. So when one of them abruptly leaves a company that, on the surface, looks like a rocket ship, well, that can be a major red flag. It raises all sorts of questions about governance, transparency, or maybe even disagreements happening behind the scenes. And finally, all this rapid growth is hungry for more cash. The board is already meeting to consider raising even more funds. Now, this could certainly fuel the company's expansion, but it comes at a cost for the current investors, share dilution, and that means everyone's piece of the pie gets a little bit smaller. So we have two completely different stories here, don't we? You have the bull case built on explosive growth, and the bear case built on rising debt and some serious governance questions. So let's zoom out and try to put it all together to see the bigger picture. This historical view shows that the recent surge, it's not some fluke. The 5-year trend is crystal clear. While sales have roughly tripled, the net profit has exploded by 25 times. This proves the company has a real track record of turning that top-line growth into actual accelerating profit. And that brings us right back here, to the valuation. The market clearly sees the growth trend we just saw, but it's also obviously spooked by the risks we outlined, that debt, the director's resignation, and the result is this low PE ratio that perfectly reflects this tug of war. It's a valuation that's caught right in the middle of incredible opportunity and some significant uncertainty.
So, after looking at all the numbers from both sides of the argument, it really all comes down to one final question.
Is this an incredible growth story that's being fueled by massive orders and real insider confidence? Or is it a cautionary tale of a company that's just growing too fast and taking on way too much risk? The data honestly supports both narratives, so after seeing all the evidence, the only question left is, what do you see?